Hi, and welcome to the summer 2026 San Diego Real Estate and Economic Update. My name is Patrick Kappel, and I'm here to share with you what I believe to be one of the most all-inclusive, data-driven economic and real estate updates for San Diego County. Well, it might not be the flashiest presentation you'll ever see. I can guarantee you this, it is going to be one of the most data-driven, factual real estate presentations you'll see about San Diego County. With that, let's get started. First, a little introduction on myself. I've been in the real estate business for a little over 18 years. I now am a licensed real estate agent working in real estate brokerage, helping San Diego home buyers and sellers all throughout San Diego County. But long before I got my real estate license, like you, I was a consumer. I bought my first property in 2008 when I was just 27 years old. A mentor of mine advised that I buy San Diego real estate as often as possible and hold on to it. And I did just that. Over an 18-year period, I was able to buy 9 properties. Majority of that time, I was serving in the U.S. Navy, buying those properties with a government income. I also serve on the board of directors for the Southern California Rental Housing Association, also for the San Diego Creative Investment Association. I now run the team that I founded, Capital Realty Group, associated with Compass. Our team has sold over $500 million. We're now approaching $1 billion in sales with over 750 units sold in just the last 5 years. At the end of the day, what does that mean for you? That means that I have a pulse on the market. I run a rather large team with over a dozen agents. We know what's going on in San Diego real estate. What brought me to San Diego, however, was not real estate. It was U.S. Navy. I served in the Navy, both on active duty for 11 years and also in the Navy Reserves. Combined, I served in the U.S. military for a little over 24 years before retiring from the Navy Reserves just 18 months ago. Well, in the Navy, I was fortunate enough to go to the U.S. Naval Academy, where I earned my undergraduate degree. I followed that up utilizing my GI Bill. I got an MBA with a focus in finance and real estate at UCLA. And I also got a second master's degree, a master's degree in real estate at the University of San Diego. You can see some of the accolades and awards over there on the right. At the end of the day, though, our team has become the #1 team at the #1 brokerage based on the number of units transacted per year. In fact, we sell about a property every other day. Our team, as I mentioned, has sold nearly $1 billion in real estate. Just last year, we sold 211 units. And as I mentioned previously, that's a little more than one unit, one property sold every other day throughout the year. So we have a good pulse on the market, and I hope to share some of that with you here tonight. Along with tonight's real estate market update, I maintain a host of other YouTube videos: how to buy your first property, house hacking 101, how to invest in 2 to 4 units, and just investing in general. I really would recommend and encourage that you check out our YouTube channel to watch some of our other videos. After watching these videos, if you think that my team and I are the right team, the educated team to work with you, feel free to reach out to me. You can see my email in the top right. That's usually the quickest and best way to get a hold of me, patrick.kappel@compass.com. I can guarantee you this: everyone on my real estate team owns real estate. Everyone on the real estate team that we run has a college degree. Everyone on our team is one of the top producers in San Diego, and we're here to help you with your buying and selling needs. With that, let's get into our presentation for tonight. I always like to give credit where credit is due. So citing my sources: John Burns Research and Consulting, Keeping Current Matters, San Diego Association of Realtors, as well as Reports on Housing. These are some great sources of information and data. I see it as my job to comb through all the articles, all the research, all the data, compile it into one concise document, the presentation that you're about to see today, that applies to you as a home buyer or a home seller. So what topics are we going to cover tonight? #1, macroeconomics. What's going on in the world? What's going on with interest rates? What's going on macroeconomically that is affecting housing and you? #2, we're going to talk about San Diego specifically, of course, as San Diego market update, San Diego real estate update, and trends that we are seeing Also, some of the data affecting those trends, demographics, who's moving into San Diego, who's moving out of San Diego. We'll talk about these things. Last but not least, we will end on some opportunities that you can take advantage of as either a buyer or a seller. I'm going to discuss a little bit how to price your property right if you're selling. I'm also going to discuss, if you're a buyer, various programs that you can utilize that can literally give you free money to go out there and buy real estate in the state of San Diego, state of California, and the city of San Diego. A couple of major takeaways. I always, in the military, we call it the bluff, the bottom line up front. So what is that tonight? Number one, the war with Iran and the associated inflation that we've seen over the last few months certainly has affected the markets. You've seen that in interest rates. You've seen it in just about everything. Number two, however, San Diego still remains one of the strongest markets to own real estate in. Values are holding steady, even increasing. So while in some real estate markets you're seeing prices go down, we're seeing them hold rather steady here in San Diego. You'll see that in this data that I'll share with you today. Why is that? Comes down to Econ 101, supply and demand. We simply do not have enough supply relative to demand in San Diego. And if you think about it, think of San Diego for a minute. It's as landlocked as you can be, really, when it comes to the real estate market and the ability to develop it. Because to the north, we can't build. We have Camp Pendleton, a Marine Corps base. To the east, we have the Cleveland National Forest. To the south, we have Mexico. To the west, we have an ocean. We have really built out on the last remaining land we have in San Diego, meaning the only place we have to build now is infill. Infill means tearing down a single family home and maybe putting up a 4-unit fourplex. One thing to keep in mind, that we don't have enough supply relative to demand. As demand goes up, prices go up. Also, this is an important one, is interest rates go down, demand will go up. Interest rates are relatively high right now in the sixes. You and I think would both agree that eventually, maybe not tomorrow, maybe not next week, but eventually, sooner than later, interest rates will go down. When that happens, demand will go up, prices will go up. This is why we're advising many of our buyer clients, at least, better to buy now before prices go up further, and you can always refinance your interest rate. A lot of first-time buyers especially don't realize that when you buy a house, and let's say you lock in today an interest rate of 6.5%, you lock in today's price, that's for sure, but your interest rate you can always change and adjust in the future by doing a refinance of your mortgage to a lower interest rate. So if you want to buy now before prices go up further, you'd buy today at today's interest rates and refinance in the future. You'll see some of the data in tonight's slide that illustrates why I would say that. Another saying I like to share, if you do not own assets, you will be left behind in this economy. I grew up as a relatively modest, some might even say poor, family in the Midwest. I was not born and raised with a silver spoon. I was not born and raised in California. I grew up in the Midwest. I joined the Navy because I really didn't have any other options financially. Served in the Navy a number of years, but by buying assets, real estate, my life was able to change. Specifically, change for the better in the sense that I was able to grow wealth and grow financial freedom. More importantly, financial security by owning assets. We live in a world today where, unfortunately, the rich are getting richer and the poor are getting poorer. The person that gets to determine which side of that equation you end up on is you. And the decision you make to decide which end of that equation you end up on, being poor, being rich, is the answer to this question. Will you own assets or will you not own assets? If you do not own assets, you will probably never build that much wealth. If you do own assets, you likely will build wealth and, again, more importantly, have financial stability and financial security. This is why I really make it my mission in life, my team's mission, to go out there and help San Diegans own assets. Most importantly, the asset that you live in, your house. Nothing reflects it more than the slide you see in front of you. This shows you the real estate net worth of all the Americans that own real estate, you can see how much the net worth of those collective Americans has grown, especially since 2015. And it's easier than investing in a retirement account because guess what? You need to live somewhere anyway. You're either going to rent where you live, which is really just tossing your money into the trash. You might as well burn your money if you're going to rent, or you're going to own what you live in. But no matter what, you have to live somewhere. Why not take advantage of this growth that American real estate experiences over time? On a related note, the amount of appreciation and growth that you see in real estate that you own really varies area by area by area. In much of the Midwest and areas that I'm from, we usually saw about 2 to 3% appreciation over the long run. In San Diego specifically, the 50-year average rate of appreciation is about 5.8%, almost 6%. San Diego real estate typically appreciates more than the rest of the United States over the long term because, again, we don't have anywhere else to build like you do in many other cities throughout America. Now, as much as homeowners are going to be the ones taking advantage of the increase in values over the next 5, 10, 20 years of real estate, there is no impending crash. There's some doomsayers out there. Doomsayers exist just for clickbait, to sell ads, to get followers, whatever you might want to call it. But there's no crash for a couple of reasons. A lot of it has to do with demographic trends. As much as the baby boomers are starting to age out, our American population is still growing. You can see there was a bit of a dip in 2020, 2021 due to COVID deaths. Nonetheless, that dip we've come back from, and our population growth throughout the United States is still positive. You'll see in a future slide that California and San Diego specifically also has continuing positive demographic growth, even with baby boomers starting to pass away now. Folks moving into the country, and more importantly, babies being born, we have that net positive growth. With that growth, we still have an undersupplied real estate market in San Diego and in the entirety of the United States. You can see here that we had a surplus of homes before 2013. As you look at the colors here, the dark blue is a surplus or the deficit of vacant homes for sale. The teal color is a surplus or deficit of vacant homes for rent. Now we hit a peak of too many homes on the market for rent and for sale back during the Great Recession, 2008, 2009, 2010. A lot of that changed over the following decade because builders got washed out of the business. We did not build enough housing. And oh, by the way, over that what I call forgotten decade, pretty much from 2011 to 2021, we just did not build enough housing. That is also the decade which millennials and Gen Z folks came of age. Specifically, millennials started aging into their 20s and 30s, first time home buying age, and millennials and Gen Z are two of the biggest generation of Americans we have ever had. So you have these two gigantic cohorts of a new generation, millennials and Gen Z, intersecting with 10 years of us just not building enough. That created the housing deficit that we now have in America. There's nothing we can do to fix the housing deficit today by just flipping a switch. It just can't happen. This is due to 10 years, a decade plus of underbuilding. So as you can see, we have a huge deficit, over 1 million units of a deficit of for rent and for sale homes, not just single family, but also multifamily. And oh, by the way, the demand would be even higher, specifically rental demand, and the cost to rent would be even higher if there were not so many young people living at home with their parents or shacking up and sharing with roommates. You can see on the left that the number of 25 to 34-year-olds living with parents has gone up 680,000 in just the last few years. Likewise, the number of folks that are living with a bunch of roommates who typically wouldn't otherwise has gone up by over 85,000. 680 plus 85, well, that's about 765,000. So you go back to this last slide, we're short 1.1 million housing units. But if you add on that other 765,000 folks that are living with mom and dad, folks that are living just crunched into housing like sardines, if you add those 765 on, we're actually short almost 2 million homes. And trust me, the day will come where these folks do want to move out of mom and dad's house and strike it out on their own. And that housing deficit will continue until we absorb everyone that needs to find a house or move out of their parents' homes. Because of the affordability, because we have so many young people living with mom and dad later into life now, the median age of the first-time home buyers edged up to 40, highest we've ever seen it in American history. Now, there's some other sources that differ over here. You can see the New York Fed is got 36 years old, Census Bureau is 35, but those are still historically high age points for first-time home buyers. I've got countless clients who are in their 20s that give me a call and they say, Patrick, help me buy my first home. I'm 22, I'm 25, I'm 26. And I tell them all the same thing. I tell everyone in their 20s who goes out there and buys their first home that they are going to end up light years ahead of their peers. Because if you buy a house in your 20s and your peers are waiting till their mid 30s or 40, you're going to be 10, 15 years into your mortgage. Your mortgage is probably going to be halfway paid down by the time your peer is starting day one on their mortgage. And oh, by the way, with the San Diego average rate of appreciation being about 6.8, that also means, or excuse me, 5.8, that also means that San Diego real estate values double about every 15 years. So imagine you buy your first home when you're 25 and you pay 600,000 for it. Your peer who waits until they're 40, by the time you're both 40, you're halfway done paying your mortgage. The $600,000 home you bought is now worth 1.2, and your poor friend has to go out there and buy the same home you bought for 600,000, and they're paying 1.2 million. So many reasons that I can honestly say the sooner you buy, the better. And it all has to do with math and the time value of math, which you'll see an Excel spreadsheet example we'll show you towards the end. I practice what I preach. As I mentioned, I bought my first property when I was 27. I bought my second when I was 29, and I just kept on buying. I was talking about Gen Zs, millennials. Take a look at the slide in front of you. We do have the silent generation and baby boomers starting to age out, unfortunately. And as I mentioned, during the last 10 or 15 years, we have not built enough housing for what is the largest two generations we have ever seen in American history. And that's millennials along with Gen Z. You can see millennials, 87.5 million of them, and they are now aging into their 40s. Many millennials are still in their 30s. What do we call this? The blue area, the sweet spot of first-time home buyers. I already showed you first-time home buyers are about age 35 to 40. And look at the large number. That's the biggest population, again, that we've ever had. And we simply did not build enough housing for them, let alone the Gen Zs who are nipping at their heels. And by the way, 95% of Gen Zs in a survey want to buy a house. We simply don't have enough for them. So what is going to happen over the long run with home values? Well, if we already have a deficit of 1.1 million homes, if there's another 765,000 people that would be out there in the world renting or owning, but they're living with mom and dad, and we underbuilt for the last 10 to 15 years, combined with the largest generation in American history, millennials, many of them still need to buy a house. What's going to happen to home prices? It comes down to what I started with, Economics 101, supply and demand. We simply do not have enough supply for the current demand, and we don't have enough supply for this tidal wave of demand that's coming at us right now. A lot of homeowners are sitting pretty happy right now because they have low interest rates. Remember how I said you can always refinance your interest rate to a lower interest rate? Well, a lot of homeowners did that during the pandemic. When interest rates went really low during the pandemic, almost all homeowners went out and refinanced their home. And today, 70% plus of homeowners have a current interest rate below 5%. This is another thing that is going to kind of tie up the housing inventory. Many people, myself included, that own a home and they want to move out of it instead of selling it, they're opting to simply turn it into a rental property because why would you sell a home that has a 2 or 3% mortgage unless you really have to? Now we are starting to see it trend down a little bit with less and less percentage of people having rates below 5%, but that's a slow trend. What this tells you and what it tells me is a lot of homes will be held off the inventory for a number of years in the future because of those low 30-year fixed interest rates people are holding on to. I'd like to share this national slide to share with you a bit about what's going on around the country. In layman terms, think about this. Any city in red, the market's not too good. Home prices might actually be going down. Anything in orange, the home market is still not that healthy. And home prices might be staying stagnant or even going down if they're in orange. Those are slow real estate markets. Anything in yellow, those are normal markets. Now, this is for 2026. In 2025, just last year, there were only two markets in green. In those, what does green mean? Hot market, good market, prices holding, prices going up, good place to buy in if you want to hold your wealth and grow it. Last year, there were only two markets in green. One was San Diego, the other was Orange County. A lot of that was due to what I've already mentioned. We have a lack of supply relative to demand. It's just not easy to add more supply. Number two, biotech and venture capital growth here has been pretty strong. Now, Orange County and San Diego have kind of fallen back to normal. Not a big deal. We're just normal, but at least we're not one of those slow or very slow markets. If I was you, I would be hesitant to buy in a market that is red or orange, because those are markets where you could potentially lose money, lose value, lose equity, versus those that have normal markets, good conditions for housing. Another interesting statistic about who's buying homes. As I always say, if you want to know what's happening in the real estate market, you've got to look at demographics because the real estate market is nothing without people. So you need to look at the people who are buying and selling homes. Now, interesting here, you can see first-time home buyers, 1985 versus 2025. Fast forward about 40 years, what has changed? Went from 75% of home buyers were married couples to now just 50. The big one that I found very interesting, single women. Used to be 11% of home buyers were single women. Now, first-time home buyers, 25% are single women. A full quarter of all first-time home buyers are single women. Compare that, skip down two to single men, 10% of first-time home buyers are single men. There are 2.5 times more single women buying homes than there are single men. So if you're a single woman out there, I guess get on the bandwagon and do what all these single women are doing. Go out there and buy your house. Many of them are doing it before they get married, have babies. And if you're a single man out there, well, hopefully you become part of that 11%, boost it up a bit, and go out there and buy a home. Personally, I bought two or three of my properties before I even got married. Then you also see unmarried couples. That has more than doubled, almost tripled from 4 to 11%. I'm seeing myself with many clients. A lot of people are partnering up to buy a house together, but they're not getting married. They're finding it more financially feasible to be able to buy a house if they're together, buying it, qualifying for a loan together. In fact, I'm even seeing friends buy houses together. They might not be a romantic couple or married, but they're just friends buying homes together because it financially makes sense to buy instead of owning, and these folks realize it. You can see that down there in the bottom. Other roommates, just friends, went from 0 to 4% of folks. So a little bit of demographics, a little bit of statistics to show you who's out there buying their first home. Now, mortgage rates. I kind of mentioned already how the Iran war has changed a lot. I'm watching it very closely because when I was in the Navy, I worked in mine warfare, and that's kind of what's going on over there in the Gulf. But mortgage rates, as of this last week here, we're sitting in the mid sixes, 6.53% as an average. As you can see, during the pandemic, interest rates dropped like a rock into the threes and then into the twos for a short period. Low interest rates caused inflation, along with the government putting a lot of money into the economy through various ways, PPP loans, EIDL loans, quantitative easing. The list goes on and on. If you want to talk economics, we could. But bottom line is a lot of money got put into the economy, and we started seeing a lot of inflation, which caused interest rates to go up, or more specifically, inflation didn't cause interest rates went up, but the Federal Reserve raised interest rates on short-term treasuries, long-term treasuries, and the 10-year treasury, which is the financial instrument that mortgages closely follow, the 10-year treasury. So when we saw 10-year treasuries going up in 2022 through 2023, we in kind saw 30-year mortgage interest rates go up, and they got above 7%, almost to 8%. Well, in the last year or two, interest rates were dropping. In fact, right before the Iran war, they dropped just below 6 to 5.99. And everyone in real estate said, wow, 2026 is going to be a big real estate year. Lots of people are going to buy, lots of people are going to sell because interest rates are finally in the fives. And that happened the last week of February. And then what happened the last day of February, February 28th? United States attacked Iran. And all of a sudden, Iran shut down the Straits of Hormuz. And all of a sudden, the world economy went topsy-turvy, and we saw interest rates spike back up. Now, fortunately, they didn't spike up as high as they were. We did not see interest rates going well above 7. In fact, we've seen them in the sixes, pushing close to 7, but not quite. And today we're sitting at about 6.5. Had the Iran war not occurred, we would likely have 30-year mortgage rates today in the mid to high fives. But instead, now we're sitting in the mid sixes. So knowing this, how should you take that data and how should you act on it? What should you be thinking? The Iran war, as my grandpa would always say, this too shall pass. It will. And when the war ends, it could be weeks, it could be months, hopefully not years, we don't know. But when it ends, I would anticipate many things, including economics, will get back to the glide scope and the tangent lines that they were on, and we will continue to see interest rates trending downwards. As I mentioned, once rates trend downwards, home prices go up. In fact, you're going to see that even with these relatively high interest rates, sixes and sevens, home prices have not gone down. If anything, they've gone up. In fact, since these rates have gone up, the median price of a detached home in San Diego has gone up to and has remained around 1.1 million. Once we see these rates go down noticeably, you will see the median price of a detached home in San Diego start rising well above 1.1 million. Down here, I want to show you a chart just based on macroeconomics, based on what we see in the real estate market. This was a document that came out in 2023 showing the effect of buyer demand based on the 30-year fixed mortgage. And we have learned that buyer demand is usually pretty weak when rates are above 7. It's limited, weak, but not too weak when we're 6.5 to 7. Buyer demand usually gets pretty good when we're 6 to 6.5. And we have strong buyer demand once rates get below 6, and we see a 5 handle on the front. Now, again, rates were at 5.99 in February. We thought this was going to be a very, very strong and fast market. Then the war, then rates got up in the sixes. So there's still some pretty good buyer demand, not as weak as if it were 7% rates. But I share this with you to indicate that when rates get back to normal, when we see them get back into the fives, we will likely see that strong demand, which will push home prices back up. That's kind of the macroeconomic stuff that's going on. Let's do a little bit of a dive specifically into the San Diego real estate market. As I always like to say, real estate's about people. Without people, real estate would not have any value. So let's talk more about people. Now, you might hear in the headlines or from your friends, your coworkers, that everyone's moving out of California. Well, that's just not true. In fact, I already showed you a slide that illustrated the population is growing in America. Well, guess what? The population in San Diego, which you'll see in a slide here soon, is also growing. What I say is it doesn't matter really how many people are moving in and moving out. It matters who is moving in and moving out when it comes to how is this going to affect the value of real estate. Now, I've circled in red the primary cities that people are moving from when they move to San Diego. Most people moving into San Diego are coming from Los Angeles, San Francisco, East Bay Area, Orange County, Boston. These are all markets that are more expensive than San Diego. Whenever we have clients or folks moving in from these markets, the Bay Area, Los Angeles, Orange County, they come down here and they say, oh my God, I can't believe how cheap San Diego is. We show someone from the Bay Area that the median home price here is 1.1, and up there it's multiples of that. So for the folks moving into San Diego is actually relatively cheap when they're moving in from these cities. That's one of the things driving up our prices. Now, when people move out of San Diego, I say not always, but often, the folks moving out of San Diego don't really affect our home prices that much because the folks moving out, for the most part, are ones that are moving because they can't or do not want to afford the higher cost of living in San Diego. We have a high cost of living for a myriad of reasons. One, quality of life, 12 months of summer. Any of you who have lived anywhere with snow understand the value of 12 months of summer. And number two, growing tech and biotech industry. And number three, last but not least, we have that military presence here that isn't going anywhere, and a large percentage of military vets that get out. They're all highly educated, highly trained. A lot of them end up sticking around here as well. But the folks moving out, they don't really affect home prices because they're usually the folks that aren't buying homes anyway. Those folks are moving to Riverside, also Los Angeles and Orange County, as you see, Phoenix, Seattle, East Bay. But I just want to impress upon you, the folks moving out don't affect home prices a whole lot. It's the folks moving in that are really driving up home prices because they are the ones that can afford it and they're moving from higher priced metropolitan areas. I mentioned that San Diego population growth is growing, and here it is. As of the end of 2025, you can see that not only is our population growing, it's anticipated to accelerate over the next few years through 2028 and then kind of level off into 2030. So our growth is still there with about a 0.5 to 1% growth year over year projected for the foreseeable future. And that's between the birth rate and between folks moving into San Diego. And this is a net. When you take all the people moving out and all the people moving in, plus the birth rate, we have positive growth in San Diego. Now, inventory. How much inventory do we have? Well, if you look at this chart, and unfortunately, May data isn't out for all charts, even though it's June 3rd. It'll be out probably in a few days. So we're looking at April, which is still a very good sample test. And you might think, wow, we have a ton of inventory. Look at all the homes. And oh, by the way, in red is single family homes, and in gray is detached homes. So think of things like townhomes and condos. Might look like we have a lot of inventory, but this chart only goes back to 2020. Let's zoom out a little bit and go back before COVID. Before COVID now, you can see that in San Diego County, on any given day, in red, we usually had around 8,000 to 10,000 homes for sale. Any given day, spring, summer, fall, winter, usually about 8 to 10,000 single family homes for sale. That's what you see in red. Today, we only have about 3,500 homes for sale, not even. You can see we've maintained less than 4,000 homes for sale ever since 2020, ever since COVID. So we're operating in San Diego with half the housing inventory for sale. compared to what we usually do. The singles family homes have dropped a lot because we're really not building many more of them compared to multifamily. But even multifamily condos, townhomes, we've seen those numbers go down, not as much, but nonetheless go down. Before COVID, any given day, you would have 2 to 4,000 attached homes for sale, condos and townhomes, as you see in gray. And today, we've been sitting around 2,000 or less. Just recently, we've gotten above that number, but the housing inventory is anemically low compared to what we had before COVID. Again, for all the reasons I already mentioned, we didn't build enough. Homeowners are holding on to their homes because they have the low interest rates. Our population is growing. Millennials, biggest population ever. By the way, San Diego's a big millennial city. San Diego has a higher percentage of millennials than just about every other city in America. San Diego, I mentioned, and I showed it to you through the John Burns slide, is one of the healthier real estate markets in the country. And this historical sales price chart shows that to you in an illustration. I always like to say, you're buying a quality asset when that asset usually sells at or around list price. And as you can see on the chart in front of you, in San Diego, home prices usually sell between 95 to 100% of list price. Even during those COVID years of 2021, 22, we saw things going above 100% of list price. That's how you know you're buying a quality asset. Now you might think, oh, I don't want to pay list price or I don't want to pay above list price. Well, if a property you're buying is commanding list price or above today, then it likely will in 5 years, in 10 years, in 20 years. I always say there's a difference between buying diamonds and buying rocks off the beach. Just like there's a difference between buying a diamond property, San Diego real estate, versus rocks property in the Midwest, places like where I was from. Right here, you're looking at closed versus last price breakdown. Now, this is where if you're thinking of selling a home, you really need to pay attention for the next minute or two here. You can see, and if you're buying, well, this gives you a little kind of inside baseball knowledge. Closed above last list price. 38% of homes in the spring closed above list price. Get that. Over a third of homes sold above list price. 19% sold at list price. 43% sold below list price. So if you add up these numbers, 81% of homes do not sell at list price. 19% do. So what does that tell you? A phrase I often say, the list price of a home has nothing to do with its value. Let me say that again. The listing price of a home has nothing to do with its value. It has everything to do with marketing. Now, let me explain. Let's say I have a home worth $620,000. Am I going to list it for $620,000? Probably not. Why wouldn't I? I think it's worth $620,000. My seller thinks it's worth $620,000. Everyone thinks it's worth $620,000. Well, if I list it for $620,000, because I work in the industry, I know this. Most buyers will not even know it's for sale unless they have a search in the MLS or on Zillow or whatever they're using to search for properties. They won't know it's for sale unless they have a search set at $650,000. Why do I say that? Maybe I enter the property into the MLS at $620,000. Well, buyers don't set searches for $620,000. Most buyers set searches in $50,000 increments. 500, 550, 600, 650, 700, 750. So if you're a buyer and you have a search set at 650, you see this home listed for sale for 620, well, you're qualified for 650. You're looking at homes worth 650, worth 660, worth 670, worth 640. Why would you buy a home worth 620? It's probably going to be the worst home that you look at because you're looking at homes worth 650, 670, some at 640, but all worth more than 620. So usually that home sits and sits and sits and doesn't sell. A month later, the agent and their client do a price reduction, but by that point, it's too late. The buyers on the market start to wonder, what is wrong with this house? Why has it sat for a month and not sold? Why did they have to do a price reduction? So what would I do instead? Well, if I had a home worth 620, 9 out of 10 times, I would recommend listing it for $599. Now you might think $599, it's not worth $599. And I agree, it's not. It's worth $620 plus or minus. But if you price it at $599, everyone in San Diego with a search set at 600,000 or above is going to know it's for sale. And they're going to look at homes that weekend, all these buyers, and they're going to see homes worth 600. They're going to see homes worth 580, 590, but listed at 600. They're going to see homes worth 605, 610. They're going to see your home that's worth 620, but listed at 599. Your home is going to be the best home they see because they are going to know instinctually it's worth more than $599. You're going to get an offer, but not just one offer. You're going to get 2, 3, 4, 5 offers. And in California, there's a rule, there's a law. If a seller gets one offer, they have to counter with a seller counteroffer, indicating that they only got one offer. And who has negotiation power when there's only one offer on the table? The buyer. However, if the seller gets 2 or more offers, they now get to counter with a different form called a seller multiple counter offer, indicating to the buyer, the buyers, that there's more than one offer on the table. This is what gets buyers to bid up. This is what gets your home to sell for top dollar. This is important to know as a seller, also important to know as a buyer. There's only one thing that will determine if you sell for top dollar, and it is not your list price. It is, did you get to send out a seller counter offer or a seller multiple counter offer? If you get 2 or more offers and you send out the seller multiple, you will create that bidding action to sell at full market value. Now, no one, not a real estate agent, not you, not even an appraiser, can tell you exactly what your home is worth, because only the market can tell you what your home is worth. Now, you might think it's weird. I told you an appraiser can't tell you. Well, if you had 5 appraisers, each independently do an appraisal of your home, you better get 5 different answers. Otherwise, they probably cheated and looked at each other's homework, because appraisal is as much an art as it is a science. So at the end of the day, just really let this sink in. Your list price has nothing to do with sales price or value, has more to do with marketing. Savvy, intelligent, strategic agents will usually price a property right below its value at one of those $50,000 breakpoints to get interest, to get a bidding war, to get a frenzy, to get you to sell for top dollar. Those are the 38% that you see up here on the top. Lazy agents, I hate to say that, but lazy agents or uninformed agents or agents who do not utilize strategy and tactics will usually just tell a seller what they want to hear instead of what they need to hear. And they'll overprice a home and it will sit and they'll have to do a price reduction. And those are the 43% down here that sell for below list price. Now, as a buyer, just because you pay more than list price doesn't mean you got a bad deal. In fact, you might have a home that's listed for $820 and it is worth $830 and you buy it for $825. Well, you paid more in list, but you got a heck of a good deal. On the contrary, just because you paid less than list price doesn't mean you get a good deal. You might, again, have a home that's listed at $820 and it is worth $805 and you pay $810. You actually overpaid a little bit. So really work with a strategic agent that can teach you these things once you get in the nuts and bolts of buying or selling a property. Next few charts that I'm going to share with you show you demand and show you supply. So what are we looking at? You are looking at the last few years, 2023, 24, 25, and now 26, the orange line with the orange dot and the arrow pointing at you. And demand is simply the number of escrows opened per month, per week, week over week, month over month. The green line that you see on top, that's a 3-year average before COVID, 2017, 18, 19. You can see the 3-year average before COVID is almost twice as many homes being sold compared to now. And you can also see that things have been pretty anemic 2023 to 2026. Haven't been that much higher or that much lower than the last few years, as you can see. We've had about as many sales this year, month over month, as we had in 2023, 2024, 2025. So the market's going at about the same speed. However, sellers feel like it's a slower market. And why is that? Let's look at the next chart. This chart shows you the amount of listings for sale, active listing inventory year over year. And as you can see, the orange line is pretty close to the red line. What does that mean? There's just about as many listings today, month over month, week over week, as there were last year. Less than pre-COVID, less than green, but not a lot less. But take a look at this. A lot more listings today compared to the purple line, 2024, certainly compared to the blue line, 2023. So in 2023, at this point, the end of May, early June, there were about 2,300 homes for sale. Today, there's about 5,600. There are over 2 times as many homes for sale today as there were at the same time in 2023. However, although there's twice as many homes for sale, there's still about the same amount of buyers buying, opening escrow. So when demand has stayed the same, but the supply of homes has doubled, it feels like a slow market to sellers. Make sense? And to buyers, it feels like great opportunity, less competition, lots of inventory out there. So this is important to know as a seller. If you listen to your neighbor who sold their home in 2023 or 24, don't expect to have the same experience they had. It's going to take longer to sell. Your home better look amazing. You better have the best kitchen, bathroom, floors. It better be spick and span and look really clean, stage really nice, really good photos. Because you can't just slap it on the market and hope it sells like you could in 2023. It takes a little extra effort now. As a buyer, know that you have more options now. You have twice as many options now as you did a few years ago. Now, you might be thinking back, well, Patrick, I thought you said that we had low supply relative to demand. And the answer is we do. You might remember from this previous slide I showed you, although our supply is relatively high compared to 2023, look here, 2023, 22, about 2,000 single family homes for sale. Last year and this year, closer to 4,000 plus, up to 5,000. So it's a lot more than 2023 and 24, but it is a lot less than before COVID. When you go back before COVID and you look at all these homes for sale, 8 to 10,000 on any given month, we still have really low supply. Historically, it's just not as low compared to 2023 and 24, which were kind of outlier years. Because we have that supply now and the same demand, market time has gone up. Days on market. What is that? From the moment a seller puts a for sale sign in their yard to the moment an offer is accepted. Not closing escrow, but an offer is accepted. And as you can see here, the number of days on market now is about 80 days, a little over. So it takes about 2 to 3 months on average for a home to sell. Some more, some less. If you do as we say, price it right, price it a little bit below value, get multiple offers, create a bidding war, you probably sell it within a few weeks. Over here, you can see the breakdown price point by price point by price point. Kind of stare at this for a moment and think about it. What do you notice? There's something I notice about it. You see the price on the left, number of days on the market, how long does it take for a home to sell? And then you compare it to last year over on the right. Interestingly, There are certain price points where it's taking longer to sell now than it did a year ago, and other price points that are selling faster than it did a year ago. Look at the entry level, $0 to 750,000. That's usually your first-time home buyer. That's usually condos and townhomes, first-time home buyer. And last year it took about 86 days for those properties to sell. Now it's taking about 97. It is taking longer to sell a condo under $750,000 than it takes to sell a $4 million house. Look at this, guys. Went from 86 days to 97 days to sell a condo under 750. And then look at the 2 to 4 million price point. It used to take 133 days, and now it's only taking 87. Likewise, look at the 4 to 6 million. That almost got cut in half. Those homes used to take 308 days to sell. Now they take 178. 6 million and up, uber luxury homes used to take 633. Well, that dropped by about 40%, and now they only take 379. 1.5 to 2 million, 91 to 74. 1.25 to 15, 92 to 82. A million to 125, 86 to 67. So when you're talking to a guy here who has 2 master's degrees, one in business and one in real estate, when I see a marketplace where the average days on market for a sale are decreasing on luxury properties, when it's becoming easier to sell luxury properties, but it's becoming harder to sell entry-level properties, what does that tell me about not real estate, but again, real estate's all about people. What does that tell me about the people, about American economics? I can phrase it up in one very well-known phrase. The rich are getting richer, the poor are getting poorer. First-time home buyers, entry-level home buyers, they're struggling. The economy's not that great right now. Prices are up, gas is up. Things are just really tough for those on the bottom. I would like to say bottom 50%, but really the bottom 60 or 70%. The top 10, top 20, top 30%, they're living the great Gatsby life right now. And you can see that in the data where it's taking about half the amount of time to sell luxury homes. Well, it's taking almost 2 weeks more, a lot more time to sell your entry level point. In fact, we see the percentage of demand is the greatest at these lower levels, but the supply at that 750,000 is actually greater than the demand. If you're a seller, where you want to be right now is probably between 750 to 1.25. Those are 2 areas where the demand is higher than the inventory. But at the end of the day, when you see the average days on market, average market time dropping by 40 to 50%, and for ultra luxury homes, and it's increasing by about 15% if you do the math for first-time home buyers, that tells you the rich are getting richer, poor are getting poorer. And that's really happening all throughout America, certainly in San Diego. Here we are looking at the median price of homes in San Diego. Even with high interest rates, as I mentioned, we're still seeing these record high home prices. The median price in San Diego right now is 1.1 million for a detached home. The median price for an attached home, so a condo or a townhome, is $675,000. So your entry level is usually around 400,000. A lot of 1-bed, 1-bath condos in San Diego you can buy for about 400,000. So if you're a first-time home buyer and you're thinking 1.1 million is too much, you're thinking 675 is too much, don't worry. Your average entry level home you can get into is usually going to start around 350 to 400,000. This is the median. So half the entry level homes are below 675, half are above. Same with single family, it's the median. And I mentioned we hit really a peak on interest rates. Well, interest rates have been high since about 2023. That's when rates really went up. And interest rates have been bouncing between 6.5 and 7.5 for the last 3 years. And you can see that our prices have been bouncing between, for single family homes, 1 million and 1.1 for the last 3 years. As rates go down, prices will go up. You'll see that happen for certain. Because again, all the charts I've shown you, if you go back in time, we do not have the supply that we usually have relative to demand. And this chart in front of you really shows it to bear about rates and payments in San Diego County. I always say we don't have an interest rate problem. We have found our peak, not on prices. Home prices will always go up. 100 years from now, home prices will be higher than they were now, and they're higher now than they were 100 years ago, 10 years ago, 5 years ago. Home prices will always go up. What we have found a peak of is not home prices, it's monthly payment. And what you're looking at in orange is the prevailing interest rates. Remember, they went down into the twos and then they got up in the sixes and sevens. We've been bouncing around the sixes and sevens. And what you see in blue is a monthly payment for the median home in San Diego plus a prevailing interest rate. Well, we have found the ceiling, folks. And as you can see at the red line, it's about $5,000. The median San Diego, not all San Diegans, some San Diegans can afford less, some can afford more. But the median San Diegan can afford about $5,000 a month. No more, no less. And we've seen it kind of bouncing around there with these interest rates. As the orange line goes down, the monthly payment will stay at 5,000 because we found that's what San Diegans can afford. And as interest rates go down, home sellers are not all of a sudden going to be super kind and say, oh, since interest rates went down, I will keep my home price the same or even lower it. Quite the opposite. Home sellers will say, oh, interest rates will go down. We have learned over the last 3 years that home buyers can afford about 5,000 a month. So now home prices can go up, and they will. I show you an example down here on what your monthly payment is for a typical $928,000 home with 20% down. A lot of people put down less, I get it. But here's just to show an illustration of math, how your monthly payment changes based on the interest rate. Now, if we break down the math, let's do an example. Let's say interest rates fall from 6.5% to 5.5%. Well, that mortgage payment, $4,692, now becomes $4,215. That buyer is saving $477,000. Remember, we have found our peak, and I know that to be a fact because we see it in the data. Look, home prices are bouncing around for the last 3 years between 1 million, 1.1. Condo prices are bouncing around really between 640 and 700. So there's this range we've been living in for the last 3 years on prices because there's a range we've been living in on interest rates because there's a ceiling of a payment. But as interest rates go down, prices go up. Now, how much do they go up? Well, if interest rates go down 1% from 6.5 to 5.5, watch this math. That's a decrease in monthly payment by 477. That decrease, 477 divided by the original payment, 4692, that represents a 10.1% delta or change in monthly payment. But monthly payment's not going to go down because sellers aren't that nice to just sell their home for less. They know that monthly payment can be afforded. So instead of monthly payment going down, when interest rates go down, home buyers' monthly payments don't go down. They stay the same. What happens is home prices go up. And I know this because I have lived through multiple real estate cycles. And as interest rates go down, home prices go up. And if the interest rate effectively gives you a 1% drop in interest rate, effectively would give you 10% savings on your payment. What that really means is homes are just going to sell for about 10% more, and that monthly payment is going to stay about the same. So a 1% interest rate drop from 6.5 to 5.5 could theoretically cause home values to go up over 10%. Right now, I showed you that the median home in San Diego is 1.1 million. If home values go up just 10%, that's another $110,000 you have to pay to buy the same home. This is why I'm telling my buyers right now, I would recommend buying now before interest rates go down because you can lock in today's purchase price. And while you can always refinance your interest rate, you can never change the price you paid for the property. So buy now because if you wait for rates to go down, you will pay more money for the same property. I would buy now and refinance later when interest rates go down. Because again, a 1% drop in rates can cause real estate values to go up 10%. So by buying now, not only do you not pay 10% more, but you also are probably going to gain about 10% equity and have your net worth go up substantially. So what should you do? Wait to buy then wait. Again, I think you know the answer. Buy now. In fact, myself personally, I just bought my ninth property now. I bought a property within the last 6 months. It's an investment property that I purchased in Hillcrest, and here's a lovely photo of it. I always like to say I practice what I preach. I drink my own Kool-Aid. I look at my own data. Because at the end of the day, I was a consumer, I was an investor, I was a home buyer long before I was a real estate agent, and I am still a homeowner, a home buyer, an investor. I look at the same data that I'm showing you right now, and that's why in the last 6 months, I went out and bought my most recent property. Um, I'm going to kind of start to close it out here with a few last bits of wisdom. Number one, if you do not own real estate, you will be left behind economically. No doubt about it. If you keep on throwing your money into rent, you might as well burn it because your landlord is appreciating all appreciation. You are not. You are simply paying down your landlord's mortgage for them. You might as well be paying down your own mortgage. And I'm going to show you one last note with the magic of math. I love math. I always say people can lie with words, but not with math. It's a universal language, hard to lie with numbers. That's why my presentations are so data and number heavy. So let's take a look at some numbers. My question for you, think about this in your head. If you could rent a place for $3,000 a month, or you could buy and own the exact same place for $3,990 a month, which option would you choose? Now, a lot of people would say, well, I would choose the first option because most people would say 3,000 a month is less than 3,990 a month. Unfortunately, that's where people stop thinking. And a lot of the times, the media, the news, a podcast, your parents, your friends, your family, your coworkers, they'll all say, why would you own a place for $39.90 a month when you could rent it for $3,000? Unfortunately, those people giving you that advice do not have advanced degrees, nor do they know how to really work an Excel spreadsheet to see into the future. Because can you see into the future? Well, a lot of people would say no. Nobody has a crystal ball. I would say you absolutely can see into the future if you have a really good Excel spreadsheet. So mathematically, let's look into the future. So I built this Excel spreadsheet when I was getting my Master's of Science degree in real estate at USD. And it looks like an eye chart. Don't worry, we're not going to dive into this whole thing. If you ever want to, just give me a call and we can look at it together. But the columns on the right go down 360 months. So you have 360 different lines, month 1 through month 360. Why? 30-year mortgage, 12 months a year. 12 times 30 is 36. And I wanted to build this model to illustrate the long time, lifetime difference of renting versus owning. Now, I hope none of you are going to die soon. I hope you all live a good long life. But if you're going to die in the next year or two, maybe go rent. But if you plan on living another 5, 10, 15, 20, 30 years, owning is always cheaper than renting. So let's take a look at what I mean by that. I blacked out some stuff. We'll uncover it slowly. In front of you, you have a downtown condo, 801 West Hawthorne Street. I know this property very well because I own it. It's worth about $500,000. You could buy it today for $500,000. And you could buy it with only 5% or 1% down, $5,000. Why is that? Because you only need to cover some closing costs because there are so many California and San Diego down payment assistance programs that I bet you my team and I could find you one of the grants or one of the down payment assistance programs in the state that will give you your down payment. So let's say that you get a grant from California, they give you the 5% down. So you put down $25,000 from the California, as you see here. So your loan is now 475. Let's assume a few things. Number one, your interest rate's 6.5. It's pretty much what interest rates are these days. Let's also assume a few other things. Down here in the bottom left, annual rate of appreciation, 6%. Remember how I said it's about 5.7 over the last 50 years? Well, in the last 35 years, it's actually higher, 6%, because I expect appreciation to accelerate because we built out on all the last usable land. Nonetheless, let's assume 6% appreciation. Now, I already mentioned you could rent it for $3,000 a month. And let's also assume reality, usually rent goes up. You might have a really nice landlord who is not raising your rent, but they're not going to own your property for 30 years. You're going to move it one day, or you're going to get a new landlord. When they sell it, something's going to happen. And in California, your rent can go up, even with rent control, it can go up between 5 to 10% a year. So let's assume you have a really nice landlord and it's only going up 5% a year. These are assumptions that we put in blue, and they're pretty accurate. Couple other things, you got to pay property taxes, about 1.25% of purchase price when you own it, and those go up 2% a year. You have to pay insurance. Property like this, probably going to be about $800 a year, and those go up every year. You also have to pay an HOA if it's a condo, not if it's a house. I put in $400 a month here. So let's look at the math. Now, again, if you own it, your principal, your interest, your taxes, your insurance, that's your mortgage. We call it PITI, principal, interest, taxes, insurance, plus your HOA. That's going to add up to $3,990 a month. You can rent the property for $3,000. I know that because I have tenants in it. They're living in it right now and paying about $3,000 a month. So again, most people would stop thinking here and they would say, well, it's $990 cheaper to rent it than it is to own it, so I'm going to rent. Well, I'm here to tell you that's not the right way to think. That's wrong. And it's millions of dollars more expensive to rent than it is to own when we start looking into the future. And if you are going to live into the future, which I'm sure you are, you need to look into the future with your financial math, your financial life. So let's look forward 30 years. If you ever wanted to, we could do we could do this whole exercise. We could look out 10, we could look out 20, we could look out 30. But let's look out 30. Because even if you sold this, you'd probably go buy something else and it's the same story and you're going to live another 30 years. Now, as an owner, you're going to pay 1.597 million. However, as a renter, you're going to pay 2.391. This is over 30 years. Even though you start out paying a little bit less as a renter, because rents go up over time, you are going to pay almost $800,000 more over the course of your lifetime versus if you owned it. Now, if you own it, you pay 1.597. You might think that's crazy. Why am I paying that much for a $500,000 condo? Well, because your condo is not worth 500,000 in 30 years. Let me show you the next bits of math. When you have owned it for 30 years, you have paid off your mortgage. And oh, by the way, your mortgage stays relatively the same for all 30 years. You have financial security because you have a fixed payment versus that renter. Now, when you get to year 31, you've paid off your mortgage. So now all you have to pay is your taxes, your insurance, and your HOA fee. And even if those are going up 2 to 3% year over year, you're still only paying $2,000 a month. This is how you can retire now because your payment's gone down so much to almost zero if it's a house. Well, you still pay taxes, I suppose, not a HOA. But you're paying less after 31 years. Whereas if you are a renter, you're paying a monstrous more. You're paying over $12,000 a month, not a year, a month. How does that happen? You probably learned this in like middle school or junior high, but it's called compound interest. The power of compounding. It's like a snowball going downhill. When you have $3,000 a month, and that goes up year over year by just 5%, 5% increase, 5% increase, 5% increase for 30 years. By year 31, you're paying over $12,000 a month. You'll never be able to retire if you're renting. This is why I say, and this sounds kind of weird, but it's true. The only people that can afford to rent are the wealthy. Because over the long term, renting is way more expensive. The only people that can ever retire are owners because renting is so expensive by the time you get to retirement age. Unfortunately, this stuff, what I'm showing you right now, is not taught in schools. Unfortunately, it should be taught in every high school. And for that reason, a lot of the people who should own, because they're not super wealthy, they end up renting because they think it's cheaper. Mistakenly, it is, but only in the short run, not in the long run. Now, the big one is what I still have covered up. Let's take a look. Net worth. If you buy a $500,000 property today and it appreciates at 6% a year over year, compound interest again, a $500,000 property going up 6% a year will be worth over $3 million after 30 years. So you're a multimillionaire now. Whereas as a renter, your net worth has gone up zero. You have lost $2.391 million, as you see here, that you paid in rent, and your net worth is zero. Whereas and you're paying $12,000 a month to keep living in the same place. That is awful. Whereas the owner, you paid 1.597, but now at year 31, your payment's only 2,000 and your net worth went up $3 million because you own the property. This is the value of real estate. This is the value of compound interest. This is the magic of math. It allows you to see into the future. And this is why I say anyone on this earth can become a millionaire. Come talk to me, come work with me. I will make you a millionaire, probably a multimillionaire, if you just do what I say. Because I've learned by doing. Again, I started buying when I was 27 and I'm 45 years old now. I've learned this stuff by doing it. I have finessed it by getting a master's degree in it. And now I go out into the world and I help people like you take action and actually live and do this. So if you want to become a millionaire, or more better, a multimillionaire, you do not need to play for the NFL. You do not need to play, you do not need to be a rock star. You do not need to play the lottery. Please don't. You just need to go buy a piece of San Diego real estate, sit on it for a few decades, and you'll be a multimillionaire. It's really not that hard. Buy, wait. With that, I'm going to close it out with a couple of last stats because I love numbers. Home ownership remains the number one feature of the American dream still. Most people, they want to retire and have a good career, go to college, but the majority of people want to own a home. In fact, as I mentioned earlier, Gen Z and millennials, 95.5% say, yes, I want to own a home. Remember, that's the biggest generation. We have a ton of millennials that still don't own, and we just don't have the supply for them, especially when they all start moving out of their mom and dad's house. Gen Z is nipping at their heels. We don't have enough supply. So you ought to get in and get your house before this wave of people come and keep on driving prices up even more. Now, this chart I share because they're things that I can easily help you out with. Gen Z, top 5 anticipated obstacles for buying a home. A lot of them think, oh, I don't have enough savings. I need a big down payment. The answer is no. Usually you don't need any down payment. Typically, if you live in California, lucky you, the state of California will give you free money towards your first time home purchase. We have helped our clients get well over $1 million using California grants, San Diego grants, to help you with your down payment on your first on your home. In fact, I don't know of another team in California that does more down payment assistance programs than Capital Realty Group, our team. Second thing is a lot of people just don't know where to begin. 20.8%. They don't know where to begin. Well, here's where you begin. Contact me, myself, and one of my team members. We sit down with you. We meet you in person, or we'll meet you on Zoom, and we will talk you through the process. My mom and dad are both high school teachers. I love teaching. Our job as real estate agents, as real estate professionals, is really to teach you throughout the process to help you buy that home. So where do you begin? You give me a call, you shoot me an email, and I and my team will help you out with the steps to buying your first home. Third problem, finding a home in their price range. We will find you a home in your price range. Don't worry, there's price range for everyone in San Diego. Not having good enough credit, talk to us. I'm sure you have good enough credit. And if you don't, we can probably get it there to where it needs to be within 6 months. Having too much student loan debt, the amount of student loan debt is not going to make or break your ability to buy. It's your monthly payment of student debt. It's something called debt to income ratio, something we can talk about during that first meeting. But I've had people with tons of student loan debt be able to buy homes. Think about doctors. They have a lot of student debt and they buy homes. Um, I mentioned the down payment assistance programs. This is huge, but between the San Diego Housing Commission and the California Housing Finance Agency, CalHFA, there are probably over a dozen programs to help you as a first-time home buyer, sometimes even a subsequent home buyer, to get free money towards your down payment. Very common, we can get clients 3.5%, sometimes even more. And as you see in the example here, if you buy your first home, 600,000, maybe it's a downtown condo or something, 3.5% is $21,000 free money in your pocket. It's pretty amazing. I mentioned my team has gotten a lot of money, well over $1 million. Capital Realty Group has helped our clients apply and gain access to over $1 million in down payment assistance that our clients have used to buy their first home. So that's it on my data. I'm going to leave you with one last phrase because I love phrases. I thought about this because I used to run track when I was in high school, and I was always nervous to get up to the finish line. Or excuse me, I was always nervous to get up to the starting line, but I always wanted to cross the finish line. I wasn't a great track runner, but I was good enough. And I realized race after race after race, in order to cross the finish line, I must first cross the starting line. You too must first cross the starting line. We get out of high school and we start to realize we might not be running track anymore, but we're all running in the game of life. And in the game of life, if you want to buy a house someday and cross that finish line, you must first cross the starting line. So what does that starting line look like? I mentioned it. It looks like a one-on-one meeting with myself and or one of my team members. What you see in front of you now is the amazing team that I have put together with top tier agents all throughout San Diego County. We work and operate from multi-million-dollar homes to first-time home buyers purchasing their first condo for $300,000. We do it and everything in between, including investment property too. If you want to work with what I truly believe to be the best and the most educated professional team in San Diego County, the way you cross that starting line is reaching out to me, sitting down with myself and one of my team members, and we will talk you through the steps to making your next real estate decision, be it a buy, be it a sell, or buying your first investment, buying your first home, or selling your 10th property. We're here to help you in any way and every way that we can. With that, I'll close it out. As I mentioned at the beginning, check out more videos on our YouTube channel, how to invest, how to buy 2 to 4 units, how to cash flow 100,000 a year, tax-free, house hacking 101, market updates. We have it all. Thank you for listening to this presentation. I hope that you learned something great, something new, and even more importantly, I hope you use this information to go out there and take action. Thank you.